Good evening, we are Tuesday, 18th of December 2018. Here's a quick market update on the Federal Reserve's latest rate-setting meeting. Corporate news may be slowing down in the run-up to Christmas, but that doesn't mean there isn't plenty for traders to focus on in the final week before the holidays. Top of the agenda is tomorrow's Federal Reserve rate-setting meeting, at which the US Central Bank is almost certain to raise interest rate by another quarter point to between 2.25% to 2.5%. Far more interesting will be what Fed Chairman Jay Powell has to say in his press conference about the outlook for further rate hikes in 2019. The most recent guidance from the Fed pointed out to another 3 rate rises next year. But that's not the view shared by traders, who expect a much more cautious approach in 2019. The odds, based on the prices in futures market, of both no more rate rises and just one hike next year are neck and neck at more than 35%. There is a less than a 20% chance that there will be 2 hikes, and traders attribute almost no chance at all of 3 rises. This matters because US interest rates help determine the pricing of many financial instruments. They have a big influence also on the value of the dollar, and that in turn is a significant influence on other assets, like share prices in emerging markets, and the cost of commodities like oil and gold too. The most recent comments from Mr. Powell said that US interest rates are now just below neutral. That was taken as an indication that the Fed is getting ready to use this week's meeting and press conference to manage expectations towards a more cautious approach after 3 years of rising interest rates. As recently as October, Mr. Powell was suggesting that rates were some way off the neutral level at which policy neither stimulates nor constrains activity. This week's meeting will be scrutinized closely for a couple of reasons. Firstly, because President Trump has been unusually outspoken in recent days in his criticism of the Fed's monetary policy approach. He has variously described the Fed as out of control, crazy, and his biggest threat. It is extremely unusual for a president to criticize the Fed chairman in this way, let alone a Fed chairman who was nominated by that president. He first started criticizing the central bank when the stock market, which he views as a barometer of his success, began to wobble in October. This week, President Trump ramped up the offensive, inevitably via Twitter, saying that he was surprised that the Fed was even considering raising interest rates again this month. The second reason that traders will watch the Fed closely this week is the message being sent by the bond market, which is increasingly flagging economic trouble ahead. With the gap between the yields on short and long maturity bonds narrowing sharply, investors are watching anxiously for short rates, which are determined by interest rates, to rise above long rates, which reflect expectation for future growth and inflation. This so-called inversion of the yield curve tends to foreshadow an economic downturn or recession. And it has been a reliable signal in the past, and it looks rather imminent. Well, that's all on this short topic. Speak to you soon. Goodbye.